Hello everyone, welcome to EduTap and welcome to today's Finance 360-degree session, which is going to be very important for all of you who are preparing for the RBI Grade B examination and the other regulatory body examination. So the RBI has recently released a notification where the RBI has released a master direction, and this is the new master direction, that is the master direction of the RBI for the non-resident investment in debt instruments directions 2025. So always remember that the new master direction, or if there is any change that has happened in the previous master direction, so these are important. Okay, so many of you were asking me to bring this session, so I've brought this session. It is a very complicated master direction that the RBI has released, but it is very important from the exam point of view, because in the previous year we have seen a direct question in regards to the investment limits that has been given in the master direction. Okay, so this master direction is going to be very important from your examination perspective, from your static perspective and current affairs perspective also. So RBI has issued the non-resident investment in debt instruments directions, and this is the new directions that the RBI has released that we are going to discuss. Okay, so good morning everyone. Good morning and welcome to the session. I hope you all are prepared for this session, because this is a very important session. Now before moving ahead, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join the Telegram channel for the PDF of the session, and the link for the Telegram channel you will get in the description box below. Give me a thumbs up if I am clearly audible and visible. Give me a thumbs up if I am clearly audible and visible. And this session is going to be very important from your examination perspective. So do hear me out very carefully. Okay. So starting with the master direction, first of all, the RBI hereby issued the following directions in exercise of the powers conferred under section 10(4) and 11(1) of the FEMA Act, that is the Foreign Exchange Management Act of 1999, and under the Section 45W of the RBI Act of 1934. So the directions have been released under the powers of the RBI, which has been granted to RBI through the FEMA Act and through the Reserve Bank of India Act. Okay, through the FEMA as well as through the RBI Act. Now, why these directions have been released by the Reserve Bank of India? What was the requirement of these master direction? So the RBI notified that in regards to the powers given to the RBI has from time to time released the guidelines for the non-resident investors. The non-resident investment can happen in India for the debt instruments, for the bonds, for the securities and such. Okay, so the non-residents, they can invest in our country, in the financial market of our country, and for such non-resident investment, for like the investment that is happening in the central government securities, the investment that is happening in the state government securities, so for this kind of investment the RBI has been releasing the notifications. Okay, or RBI has been releasing the directions. So RBI released a direction in 2000, RBI released a direction in 2018, RBI released a direction in 2019 also. Then RBI released multiple circulars regarding the non-resident investment in the government securities, in the central government, in the state government securities, in the corporate debt securities. Okay, so RBI released multiple directions. Now RBI is saying that such directions issued through various circulars as set out that we are going to discuss have been consolidated and issued in the master direction. So RBI is saying that the multiple directions that the RBI has released through various circulars, now RBI is consolidating all those directions. So the directions released for the corporate debt instrument, the notification released for the central government securities, investment in the central government securities, the notification or the circular released for the investment in the state government securities by the non-resident, all these directions are being consolidated in the master direction. So this has become a single master direction that is consisting of the most important information regarding the non-resident investors. Okay, so this is the idea. I hope this is very much clear. Now this direction is particularly for the non-resident investment in the debt instruments, in the government securities, in the government bonds, in the state government bonds, in the central government bonds, and in the corporate debt securities. Okay, so here we are going to discuss about the non-resident investment in the debt instruments. So starting with the investment channels. So RBI has laid down that what are the investment channels, and under these investment channels, what are the limits, that has also been defined by the RBI. So anyone has any idea that what are the investment channels? Any idea you have that what are the investment channels? So there is a general route, there is a voluntary retention route, there is a fully accessible route. So there are multiple routes for investment by the non-residents. So the non-residents, they can invest through the multiple routes, okay? So starting with the general route. General route is the route where there are many of the limitation by the RBI. So the non-residents, the foreign portfolio investors, they are investing in India in the government securities, in the securities of India, and there is different limitations. So general route for investment in government securities and corporate debt securities by foreign portfolio investors is subject to specified investment limits and macroprudential limits. Macroprudential limits means the concentration limit, that how much concentration can happen in a particular government security. So all of these terms we are going to further discuss. So there are the concentration limit, there is the issue wise limit, there is the security wise limit. So there are the specified investment limit, that how much the foreign portfolio investors can invest in the central government securities, how much the foreign portfolio investors can invest in the state government securities, and how much the foreign portfolio investors can invest in the corporate debt instrument. So for all of this, there is the investment limit for the foreign portfolio investors, as well as there is macroprudential limit also. Concentration limit is there, the security wise limit is there, issue wise limit is there, okay? So general route is the normal route from which the foreign portfolio investors can invest, and there are the macroprudential policy that has to be followed, okay? Macroprudential policy is the set policy that aim to reduce the risk of the financial system disruption. So macroprudential policy has to be followed, okay? So debt securities is the security that is usually through which the debt is raised, okay? Like your bonds, the government bonds, the state government bonds are there now, through which the central government or the state government is raising the funds from the investors, okay? So debt securities are the securities in the financial market through which the central government, state government or the corporates are raising the funds from the investors. I hope this is clear, okay? So general route, through the general route, the foreign portfolio investors can invest in the central government securities, in the state government securities, or in the corporate debt securities. The foreign portfolio investors can invest through the general route, but there are investment limits and there are macroprudential limit. Then there is the voluntary retention route. Under the voluntary retention route, the foreign portfolio investors, they are investing in these debt securities, but they are free from certain macroprudential limit. That means they do not have to follow the concentration limit, they might not have to follow the security wise limit and such. So under the voluntary retention route, there is the freedom that is provided to the foreign portfolio investors, as they are free of certain macroprudential limits. Why this freedom is provided to the foreign portfolio investors? Are they the family of RBI governor, or are they the family of some very important person or something? What do you think that why the freedom is provided? So under the voluntary retention route, there is some freedom that is provided to the foreign portfolio investors in certain macroprudential limits, okay? So why this freedom? Freedom is provided to the foreign portfolio investors if the foreign portfolio investors promise that they are going to keep their money in India for a time limit, for a certain time limit, okay? So FPIs that commit to remain invested for a stipulated retention period for a time limit, that is foreign portfolio investors are promising that we are going to keep our money in India for at least 4 years, for at least 3.5 years, for at least 5 years. So that means they are investing for a longer period of time. That's why there is some freedom that is provided to these foreign portfolio investors. Very good. Got it? Now, fully accessible route. Fully accessible route, here the Reserve Bank of India, informs some specified securities. There are some specified securities that are informed by the RBI. that these specified securities, there is no limit. No investment limit, no macroprudential or such limits are there. So no limits are there in the specified securities. Foreign portfolio investors can invest how much ever they want. So fully accessible route for investment by non-residents in certain specified categories. So RBI tells certain specified securities, certain specified bonds are there in which the non-residents can invest without the restrictions, without any limits. Okay, so general route, there are the investment limits, there are the macroprudential limits. Voluntary retention route, that is the foreign portfolio investors, they are investing for a longer period of time, they are promising to retain their money in India. So for them there is freedom from certain macroprudential limit. That means they have to follow the investment limit, but there is freedom of certain macroprudential limit. Then fully accessible route, without any restriction. No investment limit, no such macroprudential limit. There are certain specified securities that is specified by the RBI. So there is no limit in this because RBI wants more and more investment in such securities. Okay, this is the idea. Yes, scheme for trading and settlement of sovereign green bonds. Now the sovereign green bonds, because they are the green bonds. What are the green bonds? The green bonds are such bonds, they are the sovereign green bonds. Sovereign means government. So they are the government green bond. They are the government green bond through which the government, they are the government or the sovereign green bond. They are the bonds through which the government is collecting the money from the investors. Okay, government is mobilizing the money or is getting the money from the investors, and the government is going to use this money for the green infrastructure, for the solar power plants, for the hydropower plants, for the energy efficient plants and such. So this is the green infrastructure. Okay, so the government is raising the funds through the sovereign green bonds from the investors, and this money is going to be used for the green infrastructure. I hope this is clear. So this is the sovereign green bond, and the government will return the money back after this stipulated timeline, after the given timeline. Okay, so these are the sovereign green bonds. Now because the RBI wants to collect more and the government wants to collect more and more money through the sovereign green bonds, so that the government can invest more and more in the green infrastructure. So even for the IFSC, even for the International Financial Service Center, it is allowed that they can invest in the sovereign green bonds more freely. Okay, so there is the scheme for trading and settlement of the sovereign green bonds issued by the central government, because they are sovereign. So that means they are the government green bonds. Okay, they are released or they are issued by the central government by eligible foreign investors. So eligible foreign investors that are present in the IFSC, they can invest in the sovereign green bonds. Okay, so the foreign investors that are present in the IFSC, they can easily invest, they can have the trade and the settlement of the sovereign green bonds. Got it? Any confusion till now? Any confusion? General route, limitation, investment limit is there, macroprudential limit, concentration, macroprudential limit means that there is concentration limit, security wise limit, or there is the issue wise limit is there. Voluntary retention route, investment limit is there, but it is free of certain macroprudential limit. Fully accessible limit without any restriction. Now for the IFSC, especially sovereign green bond is more accessible. Okay, all clear. Moving forward, general route. Now we have discussed about the general route, but what are the limitation? What are the investment limits? What are the macroprudential limits? Okay, so what are these limits? First of all, general route is eligible for non-residents, and the eligible non-residents are foreign portfolio investors. They can invest through the general route. Now they can invest through the general route, but there are investment limit. And from this part, a question has come in the previous year. So remember this part very carefully, and the limits are very, very important. Okay, they are very, very important. First of all, central government securities. So if you want to invest in the central government securities, there is the limit, including the treasury bill. There is the limit for the foreign portfolio investors, that is 6% of the outstanding stock of central government securities. That is 6% is the limit for the central government securities, that is other than those available in fully accessible route, because in the fully accessible route there is no limit. So the specified securities that are present in fully accessible route, there are specified securities, okay, such as let's say sovereign green bonds. They are the specified security in the fully accessible route. They are specified security in fully accessible route, so there will be no limit under the sovereign green bond. But other central government securities that are not present in the fully accessible route, for them the limit is 6%. So central government securities other than those present in the fully accessible route, so the other central government securities has the limit of 6%, that foreign portfolio investors can only invest. If the central government securities is worth 100 rupees, so the foreign portfolio investors can only invest 6 rupees. State government securities has the limit of 2%. That is, foreign portfolio investors can only invest 2% in the state government securities. Okay. Now coming to the corporate debt securities. So for the corporate debt securities, the foreign portfolio investors can invest only up to 15% of the outstanding stock of corporate bonds. So outstanding value of corporate bond is 100 rupees. So the foreign portfolio investors can only invest 15 rupees. Got it? So this is the idea. So this is the limits. You have to remember this limit, very, very, very important. Okay. So now the investment in municipal bonds shall be reckoned under the investment limit for state government securities. So the investment in municipal bonds, they will come under the state government security. So these are the limits. Central government securities, 6% of the limit in the foreign portfolio investors. State government securities, for the foreign portfolio investors, there is 2% of the limit. Corporate debt securities, 15% of the limit for the foreign portfolio investors. Now, what are the macroprudential limits? So this is the investment limit. What is the macroprudential limit? What is the limit on the concentration, or what are the concentration limits? What are the security wise limit and such? So government securities, what are government securities that I have told you? That government securities, we are talking about government debt securities, because we are talking about debt instrument. This whole master direction is only about debt instruments. So government securities or the government bonds, through this government security or the government bond, the government receives the money from the investors. So this government security is a financial instrument through which the government is receiving the money from the investors. Okay, and the government is going to use this money, and the government has promised to return this money in, let's say, 2027, and every 6 months the interest rate will be paid, let's say 6% of interest rate or whatever the interest rate that has been decided. So government securities or government bonds is a kind of debt instrument where the government is receiving the money from the investors with the promise to pay the interest and the principal back. Okay. So now there is minimum investment in government securities through general route has some limits. So minimum residual maturity requirement. Let's say that the government security was of 5 years. Now this was released in 2020, and right now the 2024, let's say, has finished. So now this government security that was released in December 2020, now let's say it is going to finish in 2025, December 2025. Okay. So right now is January 2025. So still the investors can purchase, still the foreign portfolio investors can purchase this debt security or still can purchase this instrument. Okay. So now the NFPI and foreign portfolio investor may invest in central government securities including treasury bills and state government securities without any minimum residual maturity requirement. That means, let's say next month the security is going to mature. So then also you can buy the central government security. Let's say after 2 months the security is going to mature, then also you can buy it. After 1 year, then also you can buy it. So there is no limitation in the minimum residual maturity requirement. Okay. Coming to short-term investment limit, that if you are investing in the central government securities and state government securities with residual maturity up to 1 year, that is up to 1 year or less than 1 year, now this investment shall not exceed 30% of the total investment of the FPI in each category. That means, let's say that you want to invest, there is the government security that is going to mature after 3-4 months. So you can buy this government security. There is no minimum residual maturity. Okay, but in the short term investment, if you are doing the short term investment, there is the limit of 30%. That is, if you are investing in the central government security, if you are investing 1000 crores, so out of this only up to 30%, that is only up to 300 crores you can invest in the short term investment. Okay, so this is the idea. So short term investment is the investment that is having residual maturity up to 1 year. So if the residual maturity is up to 1 year for the central government security or for the state government security, so this short term investment you can only do up to 30% of the total investment of the FPI in each category. That is 30% is the limit for central government securities, 30% is the limit for state government securities. Any confusion here? Is this clear? So investment by an FPI in central government security or state government security, if the residual maturity is of less than 1 year or up to 1 year, so this kind of investment shall not exceed 30% of the total investment, 30% of the total investment in the like central government securities. And similarly for the state government security also, for the state government security, let's say you are investing ₹1000. So for that also there is 30% limit of the investment in the short term investment. There is also 30% of the limit. Now coming to the next point, in each category means that in the central government security and in the state government security, these are two different categories. So for the central government security also there is 30% of the limit. For the state government security also there is 30% of the limit. Okay, so as I have shown you that for the central government security there is 30% of the limit. Let's say central government security there is investment of 1000 crores. So 30% of 1000 crores up to this is the limit for the short term investment. Similarly, state government security, let's say there is investment of only 50 crores. So 30% of 50 crores is the limit for the short term investment. Got it? Yes, 30-30 for both central and state. Now coming to the next one, security wise limit. Security wise limit. Okay, so there is security wise limit also that is present. So FPI investment in aggregate, in totality, the FPI investment in totality in any central government security shall not exceed 30% of the outstanding stock of security. That means, what is the FPI investment in central government securities in total? What is the investment limit in the central government securities? Tell me fast. I will answer the extra queries, Vishnu, at the end of the session. Okay. Central government securities, what is the investment limit? 6%, right? 6%. That is, if the central government securities is worth 1000 crores, up to 6%, that is only this much the foreign portfolio investors can invest. Okay. Now let's say the total central government securities are worth 1000 crores. Out of that, a 10-year bond of the government, out of this, let's say there is a single central government security that is of 10 year, that is a 10-year bond of the government. Now this is 300 crores worth. So, or this is, let's say, only worth 10 crores. So now the limit is how much? 6% here, 1000 crore ka 6% is the limit. So now here the FPI investment in aggregate in any single central government security shall not exceed 30% of the outstanding stock of security. That means even though there is 6% of the limit in the central government security, that is for the total, but if we are talking about a single central government security, then the limit here is 30%. Then the limit here is 30%, that is 3 crore. That is 3 crore. So in this central government security, in the single central government security, that is, let's say, 10-year bond or 5-year bond. So for that, the limit is 30%. Okay. So out of 60 crore of investment that the foreign portfolio investors can do, the central government security in total, the investment can be of 6%. So 1000 crore is the worth of central government security. So 6% of investment can happen. That means 60 crore of investment can happen. So in the single central government security, in aggregate, the investment should not be more than 30% by the foreign portfolio investors. That means it should not be more than 3 crores. Otherwise, you can invest the whole of 10 crores also, no? Limit is 60 crore. But for the FPI investment in total, in any single central government security shall not exceed 30% of the total stock of the security. So total stock of the central government security was only 10 crores, but only 30% is available of this single, only 30% is available for the foreign portfolio investors. Got it? Now concentration limit. Now coming to the concentration limit, investment in central government securities and state government securities by an FPI, including its related FPIs. So let's say this is the central government security, okay? The total of the central government security. So investment in the central government securities, the total of central government securities or the total of state government securities. So a single FPI or its related group entities like the Reliance Industry and the Geo Financial and its group entities, the Reliance Power and such. So similarly, there is the FPI. There is the FPI and its group entities or the related FPIs. So investment in the total of central government security or the total of state government security by a single FPI should not exceed 15% of prescribed investment limit. What is the investment limit in central government security? Tell me very fast. 6%. So central government security investment limit is 6%. State government security investment limit is 2%. So out of this 6% of investment, let's say 60 crore of investment, out of the 60 crore of investment in the total of central government securities, that is of 1000 crores. So this 6% of investment, that is 60 crores. So this much investment can happen in the central government securities. In the total of central government securities, 60 crore worth of investment can be done by all the foreign portfolio investors combined. Now, a single FPI is not allowed to invest more than 15% in this central government security. That is, out of the prescribed limit of 6%, out of the prevailing investment limit of 6%, there is the limit for a single FPI also, so that a single company or a single FPI should not become very powerful, should not have too much of the central government security. So investment in the total of central government securities, investment in total of state government security by an FPI including its related parties shall not exceed 15% of the investment limit. 15% of this 6%, okay? In each category means for central government securities also, for the state government securities also. That is, state government securities 2% is the investment limit. Out of this, only 15% can be invested by a single FPI, okay? Now, this is for the long-term FPIs that invest in India for long term. If we are talking about short-term FPIs or the FPIs that do not invest for a longer period of time, so a single FPI or its related parties can invest only up to 10% of the 6% investment limit. Okay, so let's say 6% of investment limit is 60 crores in central government security. So a single FPI that is investing for shorter term can only invest up to 6 crore, up to 10% of the investment limit. So this is the idea that the concentration should be less. A single FPI should not hold too much power or too much of the central government security or state government security. So for the central government security, the investment limit is of 6%. Let's say it is 60 crore. So out of the 60 crore, a single FPI should not hold more than 10% if it is a short-term FPI, or a single FPI in the state government securities. Like in the state government security, the total investment limit is 2%. So a single FPI should not hold more than 10% of this 2%. 2% totality is, let's say, 20 crores. Let's just consider the 2% is 20 crores. So 10% of 20 crores is only 2 crores. So a single FPI cannot hold more than this. Any confusion here? So this is the concentration limit. Security wise limit is that a single government security, how much, like more than 30% should not be invested by a foreign portfolio investor. Concentration limit. So there is the difference in the security wise limit. We are saying that a single central government security or a single state government security should not have too much of concentration or too much of investment from foreign portfolio investors. So that's why the limit is 30% for the central government security, for the state government security. Only 30% in a single central government security, only 30% can be invested by the foreign portfolio investors, and similarly for the state government security, only 30% can be invested by the FPI. Now coming to the concentration limit. In the concentration limit, a single FPI, if it is investing for longer term, the limit is 15% of the 6% in the central government security and 2% in the state government security. A single FPI and its related entity, if it is investing for shorter term, the limit is 10% out of 6% and 2% in the central government security and state government security. So this is the idea. Got it? Yes, correct. Got it? Nice. So the CCIL, now who will take care of these investment limits? RBI will go, or governor will go after each and every investor that are you investing within the limits? Are you investing within the limits? No, na. So the CCIL has the responsibility. The Clearing Corporation of India Limited shall monitor the utilization of the investment limits for the FPI investment in the central and the state government securities. The security wise limit, the concentration limit, all of these limits have to be adhered to, and the CCIL will look after this. Okay. So there is the security wise limit, concentration limits, these come under the macro prudential limits. All of these limits come under the macro prudential limit. Okay. Now coming to corporate debt security. So we have discussed about the investment in government securities. Coming to the corporate debt securities. So if the investment is happening through the general route and the investment is in the corporate debt security. So minimum residual maturity requirement, an FPI may invest only in corporate debt securities with residual maturity of above 1 year. But short-term investments is allowed for the foreign portfolio investors. So foreign portfolio investors, they can invest if the minimum residual maturity is above 1 year. But foreign portfolio investors can also invest in the short-term investment limit. That is, there is short-term investment the foreign portfolio investors can do in the corporate debt securities, but this investment shall not exceed, the short-term investment by the FPIs in the corporate debt securities shall not exceed 30% of the total investment of the FPI in corporate debt security. So if the FPI is in totality, they are investing 100 crores in the corporate debt security. So short-term investment, that is the investment that is happening up to 1 year, that is the investment of up to 1 year, shall not exceed 30%, shall not exceed 30 crores of the total foreign portfolio investment in the corporate debt security. Okay. Coming to issue-wise limit. So issue-wise limit, investment by any FPI. So issue-wise limit is quite different from the security-wise limit. In the issue-wise limit, it is said that let's say a company is issuing the corporate debt security. A company is issuing the corporate debt security. So in the single issue of the corporate debt security, any FPI, one FPI and such, including investment by related FPIs. So a single FPI, including its related FPIs, its group FPIs, they shall not exceed 50% of any issue of a corporate debt security. That means if the corporate debt security issue is of 10 crores, then more than 5 crores cannot be invested by the foreign portfolio investors. That means 50%, up to 50% only can be invested in a single issue of the corporate debt security by the FPI. So investment by any FPI and its group entity shall not exceed 50% of any issue of a corporate debt security. In case a single FPI has including its related FPI had invested in more than 50% of any single issue before this master action came forward. So before this master action came forward and before the circular was released in 2018, so if the FPI has already invested more than 50%, so they cannot increase their investment now. Okay, so the FPIs shall not make further investment in that issue until the limit that is 50% limit is met. So simply a single FPI and its related entities in a single issue of the corporate debt securities cannot invest more than 50%. Concentration limit, that is investment in corporate debt securities by an FPI including its related entity shall not exceed 15% of prevailing investment limit. For the corporate debt security, what is the prevailing investment limit? For the corporate debt security, the investment limit is 15% of the total corporate debt security. Let's say the total corporate debt security is of 1000 crores. So 15% is 150 crores. Okay. So corporate debt security, the investment limit for the foreign portfolio investors is 15%. So foreign portfolio investors cannot invest more than 15% in the corporate debt security. Now for the concentration. Now the concentration limit for a single FPI and its related entities, they have the limit that out of this 150 crores, they can only invest 15%. That is 15% of 150 crores is how much? 15% of 150 crores, let's say it is 25 crores or something. Okay, so only this much the single FPI can invest. So this is the idea that concentration limit means that in the total of the corporate debt security, there should not be too much corporate debt security that should go to one FPI only. Similarly, the concentration limit in government security was also the same, that in the total of central government security, in the total of state government security, a single FPI should not have too much of the concentration in the totality. Similarly, in the corporate debt security also, in the totality of the corporate debt security, a single FPI or its related entities shall not exceed 15% of prevailing investment limit for these securities if they are going to hold the securities for the long term, if they are the long term FPIs. Okay. So the concentration limit for a single FPI and its related parties, for if they are going to hold the corporate debt security for a long term, is 15% of the 15% limit. Okay, is the 15% of the 15% limit. Let's say a single FPI and its related entities, they are the short term FPIs, or they are going to hold the corporate debt security for the short term, or they are not the long term FPIs. So for them, the limit is 10% of the 15% of the investment limit. Okay, so the concentration limit is 10% of the prevailing investment limit in the corporate debt security. Any confusion? So for the long term FPI, a single FPI and its group entities or the related FPIs, for the long term FPI, the concentration limit is 15% of the 15% of the investment limit in the corporate debt security. Clear? Yes or no? So this is the idea. Okay. So the concentration limit, I have shown you that the concentration in the total of the corporate debt security, the limit for the foreign portfolio investors, in the total of the corporate debt security, the limit for the foreign investors is only 15%, and out of this a single FPI can only hold 15% of the 15%. Okay, so minimum residual maturity should be above 1 year. Short term investment can happen, but out of the total foreign portfolio investment, foreign portfolio investors are doing 100 crores of the investment. So out of this, only 30% can go for the short term investment. Issue wise limit, that is corporate debt security is being issued. So in a single issue, a single FPI and its related entity cannot have more than 50%. Concentration limit in the totality of the corporate debt security, the limit is 15%. So the 15% of the limit in the totality, only the 15% can be invested by a FPI out of that 15%. Okay, so this is the idea. It is investment by an FPI. So whenever RBI is writing something, now focus on the terminologies. Otherwise, you will get confused. So a single FPI, for single FPIs, the limit is 30%. Okay. Now coming to voluntary retention route. So voluntary retention route, what is the special category or what is the special criteria for the voluntary retention route? Why they are different from the general route? Because in the voluntary retention route, there is freedom of certain macroprudential limits. There are certain macroprudential limits that has not to be followed under the voluntary retention route. So this route is also eligible for the foreign portfolio investors. So eligible instruments. So these instruments are eligible under the voluntary retention route, just the D1 is not eligible. So units of domestic mutual fund or exchange traded funds which invest less than or equal to 50% in equity, because we are talking about the master direction for debt instrument. So if the investment is happening in the equity, so that should not be allowed under the debt instruments, right? So all these instruments, they come under voluntary retention route, just other than the units where the investment is happening in equity. But if the ETF, if the exchange traded fund is only investing in debt instrument, that will be allowed under the voluntary retention route. So under the voluntary retention route, all of these securities are allowed, just the security or the bond or the security is not allowed where the investment is in equity. But if the ETF, if the exchange traded fund, if the exchange traded, that is traded on the NSE, BSE, National Stock Exchange, Bombay Stock Exchange. So if it is an exchange traded fund including the debt instrument, then this will be allowed in the voluntary retention route. Okay. So now, so I hope you have understood that any instrument that is listed here other than the investment in the ETF including the equity, other than this, all the other instruments will be allowed under the voluntary retention route, as well as the eligible instrument under the voluntary retention route is the repo and the reverse repo. So here the repo and the reverse repo is not the RBI repo rate, it is not the RBI reverse repo rate. Here we are talking about the repo and the reverse repo that is allowed in the in the trade between the different entities in the private sector also. Okay. So repo means an instrument for borrowing the funds by selling securities. So let's say I am giving my security and I am borrowing the fund from the FPI. So FPI is lending me the funds. Okay. So repo means an instrument for borrowing the funds. I am, that is Kritika, or let's say some entity XYZ Company Limited is borrowing the funds from the FPI. So repo means an instrument for borrowing the funds by selling our securities with an agreement to repurchase the security and will repay the money back to the FPI. And the repo operation can happen between me or a company and the other company and the any financial institution, company and the FPI and such and such. So repo means an instrument for borrowing the funds by selling securities with an agreement that I will repurchase the security and I will repay the money with the interest. To repurchase the security on a mutually agreed future date at an agreed price which includes the interest for the funds borrowed. Reverse repo means an instrument for lending the funds. So if I am borrowing the fund, that means the other person is lending the fund. The FPI might be lending the fund or FPI might be borrowing the fund. Okay. So reverse repo means an instrument for lending funds by purchasing the security and giving the money to the borrower, purchasing the securities with an agreement to resell the securities on a mutually agreed future date at an agreed price including the interest for the funds lent. So this is the repo and reverse repo that can happen between different private entities. So this is also eligible under the voluntary retention route. That means the FPIs, they can lend or they can borrow through the repo, repo and reverse repo. Okay. So this is the idea. Exchange traded funds are the funds that are traded on NSE and BSE. Okay. Now investment limit. So this is the idea of the voluntary retention route, the eligible instruments that can be traded in the voluntary retention route. So these are the instruments that can be traded in the voluntary retention route. So the total investment limit under the voluntary retention route is 2,50,000 crores or higher as may be notified by the RBI, and RBI notifies this limit in the different tranches. Let's say on the quarterly basis, on the semi-annual basis. So RBI can notify these limit whenever the RBI think in one or more tranches. Retention period. Now voluntary retention route, that means if there is macroprudential limit freedom that is provided to the FPIs, if the FPIs are given some freedom that they do not have to follow the certain macroprudential limit, so that means the FPIs must be holding their money in India for a time limit. Okay, so the minimum retention period shall be 3 years or as announced by the RBI for each tranche. The retention period shall commence from the date of allotment of limit. Let's say the FPI has said that I want to invest through the voluntary retention route because I want to hold my investment in India for 4-5 years. Okay, so RBI is saying very good, that is nice. So FPI is given an investment limit that okay, the FPI can invest in India under the investment limit of, let's say 200 crores. This is the investment limit, and the FPI can invest in India under the voluntary retention route under the eligible instruments. So the FPI can invest in the eligible instruments, and there is the investment limit that is also notified to the FPI. Okay, because the 2,50,000 crores is the total investment limit. So for the single FPI, there are the different limits that are notified. Now retention period will start. Now this is the investment limit that has been notified to the FPI. FPI will invest this money, let's say, in the next 1 month. So when the investment has actually happened, from then onwards, the retention period will be counted. Okay, that means if let's say FPI is investing in from March, so from March the retention period will be calculated. The retention period shall commence from the date of allotment of limit and from the date of investment that has happened, provided that an FPI that has availed additional time to invest, the retention period for the investment will reset to commence from the date that the FPI has invested at least 75% of the committed portfolio size. So the FPI has committed the portfolio size of 200 crores. FPI has said that we will invest 200 crores. So when the FPI at least invests 75% of this 200 crores, from then the voluntary retention period will start. Okay. Okay. So this is the idea. CPS is the committed portfolio size for a FPI. So CPS for a FPI shall mean the amount allotted to that FPI under the VRR. So let's say this FPI has got the committed portfolio size of 200 crores. So FPI has to invest 200 crores. So when the FPI has invested at least 75% of this 200 crores, from then the retention period will be started to be counted. It's not like that today FPI is saying that we have invested 1 crore, from today start the retention period. Why? You have not invested such a huge amount. Okay. So FPI shall invest at least 75% of its committed portfolio size within 3 months from the date of allotment of the limit that has happened and remain invested to a minimum extent of 75% of the committed portfolio size at all times during the committed retention period. So this is the idea that if the FPI is getting the freedom from the macroprudential limits, the FPI has to commit a certain portfolio size to India and they have to retain this money to India. So when they invest at least 75% of the money, then only the retention period will start. And then only like they have to continue with this money in India. Okay, so this is the idea. Any confusion here? So this is all about the VRR. Is this clear? Yes or no? Yes. So retention period 3 years, committed portfolio size. So there is the allotment of the investment limit that happens for all the FPIs, and they have to keep at least, like when they invest at least 75% of their committed size, from then the retention period will start and they will have to continue with their committed portfolio size at least 75%. Okay. Now coming to fully accessible route. So many of you must have heard about fully accessible route. So foreign portfolio investors, non-resident Indians, overseas citizens of India, as well as any other person resident outside India, as notified by RBI, they are allowed to invest in the fully accessible route. They are allowed to invest in the fully accessible route. So remember, for the VRR, for the general route, we have seen that it is only for the foreign portfolio investors that the guidelines are released. But here for the fully accessible route, there are these entities. Okay. Now eligible instruments, specified securities. Eligible instruments are those specified securities that are specified by the RBI. Okay. So RBI provides the list of the specified securities that are under the fully accessible route. So all securities included under the fully accessible route as specified by the RBI on the date of issuance of these directions. So all new issuances of 5-year, 7-year, 10-year tenors by the central government and any other security that the RBI may notify in this regard. So they are specified securities. RBI may add new tenors or change the tenors of new securities to be designated under the specified securities. So it is purely in the hands of RBI that which securities RBI will allow under the fully accessible route. Okay. Specified securities, once so designated, shall remain eligible for investment under the FAR until maturity. So once the specified security has been bought, the specified security, let's say I have bought the specified security, the 5-year central government bonds I have bought under the FAR because I am a foreigner. Okay, I have bought the central government security for the tenure of 5 years as a specified security under FAR. So until the maturity I can keep it under the FAR. But RBI for the new securities might change the tenure or might change the list of the specified security. Okay. So FPI investment in specified securities that is specified by the RBI under this route shall not be subjected to any investment limit or macroprudential controls. So this is the most interesting, or we can say this is the most profitable route. But remember that here the RBI only allows certain securities, okay, as per the requirement of the RBI. So this kind of FAR, this is not subjected to any investment limit, to any macroprudential controls as applicable for investment in the central government securities through the general route or through the other routes. So this is the idea. So this is it. Now we are at the end of the session. So FPI investment in government securities in OTC market. So we have discussed about the exchange traded funds, exchange traded securities and such. The government securities, they are traded through the RBI and such. Now coming to the FPI investment in government securities that is happening in the OTC markets, in the over-the-counter markets, that are the government securities that are not purchased through the exchanges, okay, through the NSE or BSE. So OTC market, over-the-counter markets, they are the markets that are not doing the exchange over the NSE or BSE, okay. So an FPI may participate in the government securities market, both primary and secondary, okay. So FPI is allowed to purchase the government securities in the primary market through the RBI or secondary market through the NDS-OM, okay. So RBI has the NDS-OM, that is the negotiated dealing system, order matching system, that is an electronic system through which the people or the, let's say, foreign portfolio investors, the banks, they can sell and buy the government securities in the secondary market. So NDS-OM, it provides a platform for the secondary market trading in the government securities, and this is the platform of the RBI. This is an electronic platform. Now the FPI may trade in the secondary market for government securities through the primary members of NDS-OM, including by using the NDS-OM web module. So RBI will automatically know, because this is the platform of RBI, so RBI will know that which securities are being traded, how much is it being traded and such. But let's say that if the FPI is not using the NDS-OM, so RBI will not know that which securities are being traded in the secondary market. So all the OTC trades in government securities undertaken by FPIs except transactions undertaken using the NDS-OM. So if such transactions are happening that are not on the NDS-OM, so they shall be reported to the NDS-OM platform on the trade date within 3 hours after the close of trading hours. And all the FPIs, they are all the FPIs, it is compulsory for them to have a custodian bank. Custodian bank is the bank that keeps the securities of the foreign portfolio investors in a safe environment. Okay, so usually the Axis Bank, SDFC Bank, they can be the custodian bank of the FPI, and FPI in India, it is compulsory for FPI to have a custodian bank. So whenever FPI are buying or selling the government securities, so it is happening through the custodian bank. So it is also the responsibility of custodian bank to look after that what the FPIs are doing in India, so that there is no black market trading and such that should be happening, right? So all the OTC trades, if they are not happening through the NDSOM, so it is the responsibility of the FPI and the custodian bank to inform the NDSOM platform on the trade date within 3 hours after the closing of the trading hours for the government securities market, and in accordance with the operational guidance that is issued by ClearCorp Dealing System Limited in this regard. So this is the idea. So the FPIs, it is compulsory for FPIs to have a custodian bank in India. So custodian bank, in a way, they are also responsible for keeping track. Okay, so this is the idea. The transactions undertaken through NDSOM web module shall be settled only on a T+1 basis. So the trade will be initiated today, it will be settled by tomorrow for the government securities. And if the trade is not happening in NDSOM, so the OTC market trade either settles on T+1 or T+2 basis. So T+1 means that, let's say I want to buy the government security today, so by tomorrow it will be settled, it will be provided to me. Or T+2 means today I have initiated the trade, now 2 more days, like today is what, let's say Monday. So Monday, Tuesday, Wednesday. On Wednesday the settlement will happen. Okay, so if the OTC trade is happening, so T+1 or T+2 settlement will happen, but on the NDSOM, the OTC trade that is happening, that will be T+1 basis. Custodian banks are usually the Indian banks, or they are the banks present in India. So let's say Standard Chartered Bank has a branch in India. So like custodian, for custodian bank also, now there are licenses that has to be taken. Okay. So any confusion, anyone now? This is the first question. I hope you will be able to answer this question. Okay, so this is the first question, try to answer this question, and this is the second question, that is also very important. So do try to answer this question. Okay, now if you go to edutap.in, you can go to this page, this is the website. So you can go to the courses section and you can see the courses for the different examination. Okay, and if you want to get the exam information, so in the free material you can go to the blogs and you can see the exam information also. So this is the idea. I hope everything is clear to you. So today's session was a very lengthy session. You can understand that how much time it would have taken me to prepare this for you, because it was a very lengthy master action that I can say. So just the important points I have provided you. One more thing that I want to tell you is that, see, in the short-term investment limit, so remember that in 2018 and 2019, like before directions, if a direction like the earlier directions, so if the investment has happened according to the earlier direction, then that investment can continue, but from now onwards whatever investment will happen, that will follow these directions. Okay, for the short term investment limit. But this is the overall idea. So thank you very much. Like, I hope you liked the session, and do tell me that was it like understandable, or did you enjoy the session, or should I keep on bringing such lengthy sessions, because it takes my efforts also, and if you are not like with me on this train, so it will not be beneficial on both the ends. The efforts will not be very much required. Then if it is not required, you can tell me. So do give me the right answer of the homework question, and do tell me in the comment section that you were able to understand, as well as do tell me in the comment section that you like these sessions, because they are the lengthy sessions, and usually these sessions, like either I can cover this session, or I can cover these topics in a very hasty manner, like just giving you some overall pointers. Okay, so we can do it in the shorter sessions also, but then I will not be able to discuss all the points with you. But you can tell me that what you want, lengthy sessions on these topics or the shorter sessions. Okay, so this is it. Thank you so much. It means a lot, and do tell me in the comment section if you are liking the sessions, because I am not able to see all the comments out here because there is a lag that happens now. So do tell me in the comment section, and thank you very much for joining the session. I hope you like the session. Thank you everyone. Thank you for joining.